Hello, good morning, and welcome to this session on investing in stock markets by Ladies Who Lead. Ladies Who Lead is a platform of distinguished women. I'm sure many of you are members. I'm a Titan member, and SALT. SALT is a platform that I'm a co-founder of. We are building personal finance for women and hope to see you there. This morning, our conversation is going to be about investing in stock markets, which is the topic that is occupying many people's minds. And I have the extreme privilege of being with 4 women from the field of finance, which is, and it's a rare honor, and you will know why when I introduce them. So on my left is Amisha Vora from Prabhudas Lilladher. She's the joint managing director. You've seen her on ET Now, you've seen her on CNBC, you've heard her, and you are going to really enjoy listening to her views today. Meghana Malkan from Malkan View. She is taken a different route to stock markets, which is the route to empower people by making them learn and invest and start on their journey and continue to grow. So welcome, Meghana. Sumita Pillai of Taurus Wealth Advisors. We are really looking forward to what you're building, and she and I go back a long way from our Bank of America days. So welcome, Sumita. And of course, we have with us Dina Mehta. What a rare honor to be with you, ma'am, here. I have known her in my past life when she was the chairperson of BSE, and she was the first woman to be in the BSE as a member and be a chairperson, and she has some amazing stories, and we will look forward to listening to you, ma'am. And welcome, everyone. Let me get started talking a little bit about the macro conditions, because since the time that we planned this session, and it was called Investing in Stock Market, but since that time, I think the scenario has become so very, very different. So I'm going to just ask you to respond to what are the macro conditions today that people should be aware of before they even start to think about the stock market, whether they are new investors or existing investors. I'll start with you, Amisha, and then I'll come to Deena on the same question.
Certainly. I think 2 very important things which drives wealth creation, which means we invest in a stock and the stock price appreciates. The 2 important things are, how's the business doing in terms of revenue growth, bottom line growth, market share growth, and how's the business valued. These 2 depend broadly also on the global liquidity position. Sometime by middle of last year, after a huge rally, we realized that central banks, which pumped in a lot of money to overcome the COVID crisis, have no way but to reduce the liquidity. And at the same time, because of all the supply disruptions, the costs were going up. So inflation was going up, and the only way to tame it is interest rate. When both these combine, higher interest rate impacts both demand and your profitability, the first aspects which drives growth, and lower liquidity reduces the multiple which a business gets. Both have impacted, and it's just started. So we are in the midst of this round of contraction of liquidity globally. We are just a tiny part as India, and that's how I think we are in a correction zone at this juncture.
No, actually, I would say that I'm looking at the markets. Of course, she has told us what are the macroeconomic factors which are impacting. But I have almost 4 decades of experience in the market, and I strongly believe that every opportunity is a buy opportunity for some stock or the other. So it is not a stock market, it is a market of stocks. So there is always an opportunity. Even if you look at the index, there is always a zigzag. And every point of up or down is an opportunity to entry or to exit. So I feel that markets are good if you start investing little by little, because nobody can time the market. If anybody says, I will buy at the bottom, and you will never know when the market will turn also.
Yes.
Though we feel that, oh, the factors are bad, but suddenly you feel the index is going up, everything is so rosy. And if we look at a still longer term scenario, we are the best performing economy in the world. Of course, and inflation, every time inflation comes, it drives up the stock market prices, because everybody's prices, the cost goes up, the realization goes up, and you see better workings which are there. So inflation is the mother of rallies in the stock market. Of course, the geopolitical factors are depressing the market a bit. But for me, as a retail investor, I feel everything is a good opportunity. You have to select the stocks, and once and any stock is also good enough. Let me tell you, she advises on the TV. She also must be advising so many people, buy this stock, buy that stock. So enough advice is available all around us that even in this market, there are good buys which are available. So thanks to the electronic media and everything, we have enough advice available. And I genuinely believe that these are not bogus advices, these are good advices. What is important is you should know when to exit. See, problem with most people, they lose money is because they relegate the right to sell. If they maintain the right to sell with themselves, they can buy whatever they want. There should be a stop loss and there should be a profit target. If you operate within that band, I feel every opportunity is a good opportunity.
What we see is, yes, there are a lot of millennials who are investing, first-time investors, but there is also a bit of overconfidence that is there with these investors because of the overflow of information. And hence there are certain decisions which are not done in a disciplined manner, like Dina mentioned. So for first-time investors, especially because their knowledge on the markets is still developing, and their ability to do research on companies, specific companies, is not going to be as high as somebody who's already in the market. It is always safer to go through somebody who's managing the portfolio actively. And one best way to do is the mutual funds. And there again, even a small investor, if you're trying for the first time, can start with a small amount. Even in stocks, you can do it, but of course, stocks brings in its own risk attached to it. But in a mutual fund, because it's well diversified, you can get in with a very small amount. You understand how it works. You understand the markets. You understand certain dynamics of the whole the fund management, and then they can graduate to other products. So even today, when we advise UHNIs, there is a certain allocation which is towards mutual funds. It is never that it is only exotic products. Mutual funds is something that brings in stability to the portfolio. Because of its diversification, the nature of diversification, it gives a well-diversified exposure across various market caps, which if you're going to do it with individual stocks, it's going to take a lot of time, it's going to take a lot of money. So mutual funds is always the right way to enter the market for a first-time investor.
What happens is, you interact with a lot of people who want to begin with. There are various types of people. There are people who want to get started. There are people who are managing their already existing portfolio, taken over from their parents or from their generation's old portfolio. The common thing that we observe is this lack of taking in information, or you'd rather put up as being open to learning. As ma'am mentioned, Dina ma'am, she mentioned that it's all about every stock is good. There are opportunities every single day in stock market. It's all about how you're picking the discipline to learn and to implement. So that openness to learning and openness to, being privy to more information, the right way to do things is what differentiates people who make money and people who do not end up making money in spite of trading since years altogether. And they end up blaming the market, that stock market is something which is not for everyone. Or it is a bad. Yes, exactly.
See, in every sector, there are companies which are performing very well. So, if you have a very large portfolio, you are a portfolio manager in a fund, and you have large amount of money, riding on your decisions, then I think, so much about sectors and all are important. But I am going to talk mainly from point of view of retail investor, that companies which are, good governance companies which are profitable, companies which do not have too much debt on their balance sheets, those are the kind of companies, first filter, and you will get about 700 to 800 companies in the market which will fulfill this criteria, which are continuously profit making, which do not have too much of debt, which are giving dividends. So these kind of companies with good governance, I think, is a good bet. I mean, sectors are not, your investment is too small to really influence. But of course, once you collect a large number of stocks, then you have to see to it that you are not concentrated on a particular sector. But as a small investor, say up to about 50 lakhs, 1 crore rupees, you can select good companies, you can afford to select good companies.
So I think global tech is what has taken the maximum hit on its chin. Nasdaq, I understand that more than 50% of the stocks have corrected more than 50%, including some of the largest and most well-known name. For example, even today, we all use Netflix, but the stock is down almost more than 70%. So I think this we understand as a very direct correlation. Most of these tech companies are, of course, future business models which are emerging. They are having good market share, but most of them were not making money. And the whole valuation, which is the very important second part, was dependent on 5th year from now, 10th year from now, 15th year from now, that they will make money. And the way to then calculate is discounted cash flow. The moment the yield goes up, the whole discounted cash flow crumbles down. And that's how we see that the now justification for valuation is this, at this interest rate. The business is doing something which is any which way happening.
That cannot change.
That cannot change. But what can really change because of this collapse of the market cap is their ability to raise fresh cash, because they are all funding their growth through raising cash. So market cap is not having an impact on business model. We always said business is doing well, so what if prices have fallen? But it's all interconnected, and their ability to fund their growth, fund their loss, and raise capital definitely gets impacted when a severe correction happens. Even in 2001, there were many survivors, like the Googles and Amazons are survivors of the last tech boom. And I'm sure this time also there will be many survivors who will get majority market share, but the collapse is largely to do with what happened on the interest rate and liquidity outlook.
If I may call the high net worth customers as savvy investors, because they've been in the market for a while. Not always, but I would still just to kind of
Supposed to
give
be.
give you a flavor of what it is. So if you assume they are the savvy investors, there is a lot of emphasis on quality that they lay on. For a retail customer, it is what you advise, whereas and you can advise on various parameters. With an HNI or an UHNI, there is a lot of emphasis on quality. And that is what kind of also helps them to zero down to a particular sector. So unlike a retail client who has stocks across various sectors, they will want to zero down to a particular sector. They would want to screen the companies within that sector, understand the parameters, which is purely whether the business modes, the market size, competition, the growth prospects, performance in an unpredictable market. All these are very important when they choose a stock. So there is I wouldn't say a paradigm change from a retail investor's mindset, but yes, they are far more specific when they come to investments. And they are open to also taking higher risk, right? So the allocation, they're willing to maybe take a larger risk in mid and small cap. There are times that we have to tone down that expectation and tell them it should be more diversified. Core should be your large cap and a little exposure. So there is the risk taking ability is much more. And for a retail, I think the time frame to stay invested is much longer, because they're putting it with an objective. Whereas with an HNI, there is a return expected. So 3 to 5 years is the kind of time horizon one would look at.
A very basic approach that we all should take collectively as someone who is trying to build up something here into trading and investing could be to approach this whole thing as a business. For instance, you're starting a business. What would you do? You would evaluate everything, and you would ensure that the raw material that you put into your machinery is the same. So the input is the same to get the same output, right? So we just have to ensure that the input that we put into the trading business, which is your systems, your strategies, everything, they're all the same so that you get the same output, which is profit, which is money making. So I think you all should focus on it as a business and also at the same time as a profession. Should you have to become a lawyer or an engineer, you would ensure that you put a minimum number of years of study plus a few years of practice to ensure that you're successful. Unfortunately, when it comes to stock trading and investing, everybody thinks they're an expert. Because you don't need a qualification to get started, right? You can start at any age with any amount of capital, which is a good thing, of course. But without any knowledge could prove really fatal. So if you really think it's a profession and I need to groom myself in terms of my knowledge and my practice, then I believe, especially for women, I think this could be one of the most rewarding professions. It could be because I've worked as a corporate lawyer for more than 7 years. I've been with the UB group and then I moved here. Honestly, though I enjoyed every bit of work that I was doing there, but I feel, being an investor has been very rewarding with the freedom of time, freedom of choice, and freedom of money that this profession has to offer.
Actually, people work in extremes. Either they are too much stuck on trading, they are constantly looking at prices, or if you see 30 people in 30s, 40s, they have just bought the things, they have kept it, and they don't even look at it. So one who is serious about investing and who accepts their own shortcomings, I think such people should go for wealth management firms and this, or else at least once a week devote 1 hour to looking at what you have. Because there are enough theories which say that just taking a review of your portfolio improves your return by 50%.
50%?
Yes.
Wow.
It improves by 50% because every week, if you see, you need not see every day. Every week you see, you will correct your things, how the prices are going. Have a register, just maintain what was the price movement during the thing. I think that kind of 1 hour effort, that is also very, very helpful. So either you go for wealth management, of course, where you require 50 lakhs, 1 crore, 50 lakhs is the minimum PMS amount which is there. So I think instead of being stuck on the screen all the time, which I see, and lot of women also do that. And I tell you, in kitty parties, the discussion is about what positions they have and what they are doing about it. So there are such extreme cases also. There are on other extreme people who don't look only. So many people come, oh, my father, just now I had a friend of mine whose both his parents have died almost 5 years ago and they have 5 crore worth of shares. And it took us almost 1 year to get everything transferred in their names. So both extremes are there. So I would suggest that, and as you rightly said, women are most suitable for doing this kind of work. My often repeated phrase is that men are good at earning money, not necessarily at managing money. So it is the women who manage the money. So women are very good at managing money and they should be managing the family portfolios. As it is, they manage incoming and outgoing. Same thing, you can extend it to investments also.
So first, just for the sake of clarity, I would say that we're talking about two things here. One is trading and one is investing. And these are two different things. So first, whenever anybody wants to dabble into markets, they have to make a decision that this money I'm putting for trading, and if that is for trading, which means that it is a short-term trade and there has to be a stop loss. And of course, booking of profits. But if it is investments, you go a little more deep into it to understand how the business is likely to do for a few years. When we intermix, most of the time outcome is bad, and outcome is with a small profit, you will book. With a huge loss, you will keep holding. From trading, you will become an investor and not knowing when to navigate.
Yeah, whichever suits you at that time.
Yeah,
Do not
yeah.
take action.
Do not take action.
Yeah.
So that is one thing which will correct a lot of positions where you then keep not sleeping in the night, not realizing what to do. Secondly, for any of these investments, you have to decide your framework. And that framework means that what am I really expecting? When I invest my savings, I'm okay to 30% reduction, mark to market as we call it. Or no, I want a good 12-15% consistent return, which beats inflation and any other asset class. What is it that I want to invest in? If you try and answer these two questions, I think the journey will be a little more smoother. And one more fact which I would like to highlight is that globally, 90% of active fund managers are not able to beat index. So, the safest, sanest, most cost-effective way of converting your savings into wealth is also to invest into index ETFs, because best of the breed of stocks become part of the index. But this applies to investor who wants to long-term build wealth and convert savings into wealth. So ETFs or passive investments is nothing to be ignored. Only when you, as what she very rightly explained, for anything you have to invest time and have that skill. You are committed to acquire skill, do trading, do personal investments. Otherwise, go into cost-effective way of going through either passive funds. One very important aspect which I would really like to highlight is that globally the research shows 90% of the wealth is created by asset allocation. Only 4% of the asset wealth is created by stock selection. Only 2% of the wealth is created by market timing. So we invest 90% of the time on this 6%. And I will be very happy to say that in last 2 years, we have a team of quant managers, all CA, CFA, machine learning, Python, economists. And what we have with all the historic backtesting done is called a portfolio, which is wealth for women. Knowing precisely how the initial navigation is required through asset allocation. Some understanding will really help. It's not the idea to really pitch, but idea to first give an insight as to these are the aspects which make a difference in wealth creation. Stock selection is a very, very detailed exercise which should be given to professional fund managers, whether under PMS, AIF or mutual fund. But asset allocation is something.
So, no, that's really remarkable, what you said. In fact, today is the best conversation I've had in a long time, because all my segues are just coming from all of you. So I don't have to really think. So what you were talking about reminded me of a very important thing. And I was sharing this anecdote about what our research showed, which is that, you're 18 and or even when you are 12, your parents bought something in your name, and then you started working, and then somebody told you to buy ALSs, so you bought something, and then some colleague told you to buy something, then you bought some stocks, then somebody told you to buy some crypto because it was the hottest thing, then you bought some. And then by the time you're like in your late 20s, you have this mishmash of a portfolio. Half the thing you don't even know where they're lying. And by the time you're in your 30s, because you're also busy with your career growth, your family, your other commitments in life, you kind of become, you don't even want to look at this thing, because it's just like not that part of your house where you never go because it's just way too messy. It becomes like that. And I think, so when you talk about asset allocation or looking at your portfolio, I can 100% believe that it will give you 50% more return, because if you start looking at it, it will, it's like improving the feng shui or whatever they say of your house, because you are looking at things and keeping them straightforward. So, so best of luck to everybody with that. I'm going to ask a question, and please think up your questions, because we will be opening to audience questions.
Actually, to supplement
Yes.
what she has said, that it is, one is, and to, add to what you are saying, that assets are lying all over. Our concern for financial assets is simply nothing compared to our concern for other assets.
Yes.
You get a silver coin, you will put it in the safe. You buy a gold necklace, you will see, you go and put it in the bank safe. But a 1 lakh worth of certificate of shares, it is lying anywhere, and you are not aware about it also.
Yes.
So custody of financial assets is extremely, extremely important, which is most neglected thing by everybody.
Yes.
Like we say, bank FDs, are the bank FDs renewed or not? What is
Yes.
the rate of interest? Company FDs,
Yes.
did your debentures get redeemed?
Yes.
Your share, did you get the dividend or not? Even nominations, when you are not married, you take out an insurance policy, nominee is mother. Most of the cases, you get married, you don't bother to change the nominee, or it may be your brother.
Yeah.
Same thing with houses. People don't make nominations for their houses, and then there's a huge legal process. I have handled at least about 25 probate cases for my various customers in my career, and nothing takes less than 5 years.
Yeah.
If the shares are left in single name, to get a probate, you take 5 to 7 years. So hopeless the entire legal system is in getting probates. So custody of financial asset is as important as managing how your portfolio is performing. Where it is also important, because if like I had written a very popular article called Life After Death. So once you die, you have collected financial assets for your near and dear ones. So are they in a position that they can actually live with those assets?
Yeah.
And many times it is not so.
Yeah.
Because people have not bothered to make the physicals into DMAT.
Yeah.
They don't check their DMAT certificates. They don't check if there is a nomination in the DMAT certificate or not. So many small things which are relating to the custody of the assets, that is missed out by most people. So when you talk of investing, we should also talk about custody of the financial assets.
Yeah.
Your mutual funds, did you get a regular statement? You got it, put it in a file. Otherwise, when there is income tax return to be filed, you run all over the place looking for papers. You call up your brokers, give me full year's transaction statement. These kind of things should not happen.
Very, very, very correct. And I think this is part of the discipline that we talked about. And if you want to be that trader, then you need a very rigorous discipline. If you want to be the investor, you need discipline of thinking about why are you doing this? What do you want to happen with this money in your lifetime, post your lifetime? What will make that happen? Please pay attention to all of these things together. Don't keep switching between one or the other, being lazy, whatever it suits you. And thank you. I mean, this has been such a wonderful conversation, and we will continue, but I do want to take any questions that the audience may have. While you think up your questions, Sumita, both of you actually, I have
something to
Go
add
ahead,
to
go ahead.
what
Yeah,
Dina
yeah.
said, that it's about, what kind of value do you add to your investments? Traditionally, in our country, it's always been that, as you rightly mentioned, we had a lot of value to our physical assets, as the gold coins or the silver coins or the jewelry. In fact, recently I had a very interesting conversation with a friend where her husband offered to buy her gold ETS for her 40th birthday. And she said, no, I want a gold necklace instead. Where she, so I was having this conversation that, are you even aware of the kind of returns that your ETFs would generate as compared to the happiness that you get while wearing this gold thing? I mean, very individualistic thing, but the psychology. And when you compare this to the West, there's research which says that more than 50% of people in the West invest into financial assets. The ratio here in our country is 4%. The divide is very huge. So we need to open up to the possibility of placing that kind of importance to financial assets. Only then we'll do all these things, that as allocating an hour to our investments, managing them, seeing where the demat account, etc. So that kind of awareness, once it opens up a lot of possibilities for us women, I think.
Yeah. To be fair, the necklace does look better than that piece of paper.
but I'm happy to say that my daughter-in-law to be,
Yeah.
she has asked for sovereign gold bonds.
Oh, wow. You chose well. Your son chose well. So, we could have a very interesting follow-up discussion about the psychology of money and why people actually neglect
That
things
book
like
is
this.
very good,
Yes.
Psychology of Money,
Yes.
which has come recently.
Yeah.
And it is, it is our upbringing and our approach to money that really determines how you invest.
Yes.
That is very important. That,
Yes.
how, some people are coming from poor families.
Yes.
What is the value of money to them?
Yes.
Some
Yes.
come from different kind of families, certain instances in life where you really struggle for
Yes.
money. So all these also
Shape
determine
your attitude.
your investment patterns and how you invest and where you invest.
Sure.
It comes out of it.
Yeah, so in fact, you were asking why we chose to call our company Salt is exactly because of that. Because salt is an ingredient that you always put according to your taste,
Yes.
not according to somebody else's recipe. So that's very true. I wanted to ask you a question that sort of emerges from the discussion we are having, which is about risk and in investing or in trading or in this whole space of managing money. One of the things that everybody hears about is risk appetite, or what is your risk appetite, or risk management. And I want you to just very quickly tell our audience about how, in a simple way, should they be thinking about risk.
Sure. So, yes, risk appetite is extremely important when somebody is looking at building a portfolio. But it comes with a lot of other objectives that we kind of profile the client with. Risk is not just about just the money being invested and you're losing 30%, 20%, or to what extent you can lose. But one needs to also, when we kind of approach a client and we build a portfolio, we bring in the whole concept of how to generate an alpha and what is the approach to be used. So we always suggest a top-down approach, but we also, while doing that approach, we gauge the risk of the client, and then we try and build a very balanced multi-cap kind of a portfolio. So very simple, if I have to say, everybody needs to look at diversification, very important. Emphasis on quality, again, like I earlier said, is very important. And how do you minimize the risk? Nobody can say there is no risk. Today, no investments, including a bank deposit, has no risk attached to it. Everything has risk. But how do you minimize the risk? And how do you kind of make sure that you realign the portfolio on a timely basis? And that is to take from what Deena said, that portfolio analysis, portfolio review is extremely critical. So portfolio review periodically needs to be done. Realignment of portfolio needs to be done. And we need to then build in what is the current environment. Inflation is at a record high level. What is the sector we would talk about? We would still say stay in defensive sectors, but keep a certain allocation open for IT and BFSI, because we've seen outflows there, decent valuations there. So risk is just a lot more than just talking about how much you're going to lose or gain. So it has to be
more comprehensive
and
thought of. And all of you are giving me so many segues that I'm a little bit excited. So on that segue, I wanted to ask you this question, and everybody can please chip in. And that's about in the current environment. I know we are talking stock market, we are talking investing, we are talking trading, but we have to talk about the bond market and what's happening on the rate side, and what does it mean for a retail investor or consumer today with what is happening in rates, because across the world central banks are raising rates, and we have lived through a regime of low rates for quite a while and rising stock markets, and now suddenly it's like
correcting the
yes.
So I think in last cycle of last 5 to 7 years or 10 years, a lot of investors would have realized that it's not that bond market is all about getting fixed return. It's also a lot about the risk of the underlying corporate.
Yes.
There's also about risk of the rate cycle, because of which the price of the bond keeps moving. I think we are once again like correction in the stock market, as we believe as a house and our research. In terms of even bond yields, we are in the midway in terms of where we should be, because the real interest rate in India is still negative, which means inflation is higher than the interest that the people get on their savings. And gradually it will be corrected, which is what even RBI governor believes. Once that cycle happens and bond yields go up, bond prices come down. So even that, within that bond portfolio, we have options of being into liquid, which means we don't take chance with the tenure of the bond. We go into government bonds and we go into corporate bonds. So each has different risk. Also, each has different rate cycle. Ideally, right now, looking at the scene, liquid is the most preferred,
place to go.
Where you can protect first your capital.
Sure. And give us your practical advice.
I think Reserve Bank of India bonds, which are sold by, I think, HDFC Bank and all, they give good yield which is there. Other than that, FDs are there. You have to go for most highest rated FDs. That is what take it HDFC, Shriram, Bajaj. These are the most popular ones where they are perfectly safe. And I think certain portfolio, at least 15-20% must be in a fixed return, fixed return portfolio, because somewhere, of course, we try to select stocks in the best manner, whatever we do, but some first fixed income is necessary. And for gold also, I think I am very, I think in 5 years gold prices have doubled, and we can still see better appreciation in gold also going forward. So buying these sovereign gold bonds which Government of India issues is the best possible instrument so far as gold is concerned, because government is giving you 2.5% return every year. If you buy a gold necklace, how many times will you wear it? And these days, I'm telling you, young people are absolutely comfortable in hiring jewelry.
Mhm.
There are enough places where you can hire the jewelry. Why should you buy jewelry? I mean, one of my friends, extremely rich family, and the girl insisted. She said, if I have to buy to match my sari and everything, I might as well hire, and can hire real gold, and real diamonds and everything you can hire. So I think sovereign gold bond is a good investment option, and so fixed return, I would say that one is these FDs which are there, the Government of India RBI bonds, and of course now it is very easy for retail investors to buy RBI loans also, government securities, and T-bills. T-bills, if you have short-term money for 2 months, 3 months, if you buy T-bills, their maturity is 90 days or whatever, and you get 6 to 7%, which is definitely better than your bank return.
Yeah, but would you buy it yourself, or should you buy mutual funds?
No. If you,
No?
I mean, we are looking at fixed interest.
Income?
Yes, mutual fund is a good option where you go for fixed risk. But these direct instruments are also available for you, which are same way as you buy a mutual fund, you can buy these instruments.
Sure. And then again you will buy, and then because you hear on this podcast, and then you will be lazy and you will not sell it when
No, it will mature after 90 days, 60 days. So there is a maturity cycle which is there. And fortunately for lazy investors, our bank accounts are captured with the depository, with
so the
Demat.
money will just come
So
back
they
to
will
you.
just come back to you.
So you don't
that
need
much
to worry about
safety is there.
Okay.
So if you ensure it is in your account, then you will be safe. Then they come back.
Sure.
So the system, I think today we are in such a heavenly kind of period where the safety of your assets,
Yes.
the SEBI, government, everybody ensures it that it is completely safe. And it is so easy, at the tap of a button you can see everything which is there. Or even if you phone your broker, for him also it is very easy. He taps a button and he emails you your statement.
Yes.
So things are really, when it comes to the maintenance of your financial assets, beautiful systems have been made, and I think one should use those systems and see to it that, because even if you buy a house, such a hassle it is.
Yeah.
You make an agreement, you stand for hours in the line for the registrar to sign. You have to have a setting over there, so that moment you go, you sign. So all these things are there. But when it comes to
Also, the plumbing is never good.
Yeah. So if you the atmosphere is bad, there's no AC over there, let me tell you. But if you look at financial assets, I think it absolutely, because of the trade guarantee funds, your money, your funds are safe. Because of depository system, title of your this is safe. And because of online trading, the rates at which you buy, they are all safe. And today online is not just available for stock market. You can buy ETFs online, you can buy mutual funds online, you can buy gold bonds online, you can buy T-bills online. So what more you want? I think you are in a heavenly situation, because I have seen the paper age. When my son used to sleep on the outside sofa, and I would prepare the shares till night 11 o'clock to make the pay-in on next day. All those things are now gone. So we are in a much better situation.
It is so wonderful to hear that. And if this doesn't get you guys out of your laziness and start using your money, so live in a rented house, rent that jewelry, rent that whatever that branded
use Ola and
Ola
Uber.
versus use Ola and keep your money because your money is safe. When we say your money is safe from a counterparty risk. Nobody is going to run away with your money, but you have to learn to deal with markets and volatility of the markets. If you have questions, please ask.
I have a question on peer-to-peer lending as a mode of investment. Anybody, I mean, if anybody has a
For
point.
peer-to-peer lending.
Yeah.
Means you want to give money to your friends.
Yes.
No, there are actually portals.
Platforms.
Acha, portals.
There are platforms
okay, yeah, yeah.
through which you
Yeah.
can directly lend and at very high rates of interest.
See, anything unusual is with lot of flags. So you have to, because ultimately think that the person who borrows from you is he going to make that return. And I will tell you, there are upteen number of stories when in mid-90s, all the leasing companies, and Bansali was one of them, and so many leasing companies, they came up with 36% return.
Yes.
Now, if you are lending to somebody at 36%, is that person going to earn 36%? Look at the best of the company balance sheets, 10 to 15%. 10% is very good. 15% is outstanding. If those kind of returns are there for most of the best performing companies, how can somebody earn 36%? So what it does not, it is all about common sense. What is not common sense is please stay
Risky.
away.
It's risky.
Stay away.
Comes with a
But
risk.
to add to that, as an investment, one can look at the unlisted space, where the companies are, gearing up to get to the IPO levels. There is a lot of factual data available to see how the growth is projected. That is a better bet, I would think, rather than going in for a peer-to-peer and then, like Deena said, higher interest rate, higher risk. But here, there is a lot of facts to support you with that investment. Similarly, strategic investment opportunities, like, if there are startups who are looking for raising funds, that could be a better opportunity.
But maybe a very small amount to start. I mean, because the returns.
Actually, see, if you have money to waste, you have reached a stage in life where you just want to have fun. I'll tell you, I had one customer. He was 90 years old. And every year he used to lose at least 2 to 3 crore rupees in trading. 2 to 3 crore rupees. But his family was very happy. They said because he's occupied from 8 o'clock to 5 o'clock, he calls up everybody. Everybody is happy because at 1992, how his health will fail, whatever will happen. But because of the stock market, he was a highly active person and interacted with everybody. So if you have reached that stage in life, then you should experiment.
Not yet 90, but yeah.
So, okay, since
I would suggest when you are having enough, that you are satisfied with whatever you invested, some small amounts you will experiment, but it is not advisable that you think
Depends at what stage you
So
are.
I have to say this because I have to take your question because I think I'm the only one here from the classic debt space. So peer-to-peer lending actually is a phenomenal proposition if you think about it, because what are you doing? You are disintermediating institutions which exist on that margin, right? Because one person has the need to invest money and make return, another person has the need to borrow money and grow, and financial institutions do that intermediation all the time, which is where their job lies. Because technology has changed so fundamentally, now you have the opportunity to know that person and understand that person's credit behavior, and therefore take that credit call yourself, which you were not able to do that. Theoretically, philosophically, great, it's similar to crypto, right? We haven't gotten into a crypto conversation, but it's very similar, right? When you think about a decentralized monetary authority, when you think about taking power and giving it into that, philosophically, great ideas. When you put your own money into it, it is about how much due diligence you're able to do, how much can you trust the platform, how much information are you able to get. So what Deena was saying is where I will add, and I'm going to date myself, because I was in RBI when that CRB thing happened. So
You
So-
know how it happened.
so I know
all
what
this
happened.
36% return.
And for years together,
For years together.
I signed advocates' bills
Yeah.
for that particular case. So yes, so things like this
And
will
then
happen.
Vatsa Finance, one more was there. Vatsa Finance, similarly.
And so
36.
many, and then there were those forest things and
Yeah.
tulip.
Yeah.
So the financial history of the world is full of opportunities that come up and sound amazing, and then sometimes they play out and sometimes they don't. But that's where we were talking about risk. So you have to you be comfortable with what you. My personal theory is that you invest for stability, you invest for growth, you invest for emotions, which is why even though that necklace sounds unreasonable, you will go ahead and buy it. And you should, especially young people, invest a little bit for fun, like she said. Or
Yeah.
now with your example, maybe when you are very old as well. So
you invest for fun, yes.
so your asset allocation for your life has to take into account all of these things, because what's life if you didn't take a little bit of extra risk? Anybody wants
No,
to
but
add?
one thing in this I would add is that what is the maturity or vintage of that product? See, as a developer, when she is also a startup developer. When you develop a product, there will be some bugs, there will be things. Plus, you do not build in lot of use cases. What if cases? What if somebody does this? What if somebody does this? So, as a product matures, the what if cases, they keep on getting settled. So maybe after 2-3 years, it is a reasonably, I would not say 100% safe, but reasonably safe, then you can have fun. But, it should not be a primary,
It's
place
exactly
where
like,
you
it's
put.
exactly like crypto, right? A lot
Yeah.
of people are dabbling in crypto. They put aside some money, which they know even if they lose, there is nothing. There's going to be no pain. But that's the kind of thing
It's
that
not
you need
3
to
crore
look at.
for all
It
of
is,
us,
yes.
but yeah. Good something.
No, I can tell you a lot of investor stories, but some other time.
Sure.
As to, how.
We will do a session, Anisha, on stories.
But it's amazing to see the younger generation dabbling in crypto, and they are seeing they're seeing good
Crypto
times.
accounts are more than the equity demat accounts.
Absolutely,
Yeah.
absolutely.
Yeah, yeah,
is
yeah.
much more.
Yes, yes.
And they are building their risk
Yes.
appetite in a completely different way.
No, there,
And
but no,
also the
there is no
downside is-
asset supporting the crypto.
Absolutely, absolutely.
And even if government used to have gold, now it does not have gold, but there is a government guarantee so
Yeah.
far as our currency is concerned. So crypto again for fun, little bit is okay. But because let me also tell you, people who are hackers of the systems, they all demand in cryptocurrencies.
so there is a market for
Yeah,
it.
it is a smuggler's market.
And you don't know when the government stand will change on cryptos, right? So then suppose if that completely they
No,
don't
that
support.
is regulations.
Yeah.
Once they come
Come
the
in.
things are very different.
Very different. Yes.
Do
Thank you very
would
much.
you like to add something? Oh, there is another question. Please go ahead and ask.
Hi. Thank you so much. It's been a fantastic session so far. My name is Anuya. I'm a part of a platform that's building a social community platform for women. It's called Co2 Come Together. And I'm glad we're having the crypto conversation because I think it's the elephant in the room. I think the point of having a social community platform for women is basically it's based on Web3, right? Like you said about decentralization, and we want everyone, all the women in this room, to participate in a token economy. And while I have heard some of the conversations you've had about crypto so far, what do you think about crypto and NFTs, and why should, I know that globally there are a lot of women who are creating awareness about why crypto currency and investing in crypto is important. And they're also encouraging a lot of artists to invest in their NFTs because, they don't have any middle person to sort of, get the money in. They get the money directly. And a lot of musicians are doing it as well. So I personally feel it's important, not just because we're building a platform that will support it, but would be nice to hear. What you
Sure.
think.
So first of all, you said crypto is the elephant in the room. At this point in time, it's the cat, more like. but let's get the
So
cat
I have
out.
a very different view on crypto.
Yes, please.
I know most of my peers who are in the financial markets and who've been used to looking at things which is backed by either business or gold or something,
Or
government,
Yeah.
are very anti-crypto. Somehow I feel that crypto is here to stay and grow because the malice of the current system in terms of navigating any event through just printing money and debasing the currency is so high. And if crypto, the way we know, is supported by the whole technology behind this, it's a question of time when this will be recognized. Because it is not recognized, there is a huge volatility which one has to brace to be part of. But I am somehow of the opinion that crypto is here to stay and grow. Because people at some point will take away the power from governments to just keep deciding their fate. And the way things are shaping up, it's very difficult to say. But globally, over the next 5 years, it's possible that dollar itself will get debased. The way they have printed currency.
Of course.
The way the rest of the geopolitical events are shaping up. So I somehow am of the opinion, I don't have a clear path, and many do not have, but I think crypto is here to stay and grow.
So I do these, we don't have so much time to talk about it, but I will definitely invite other views. But we do these Twitter space conversations on Tuesdays, and we talk a lot about the new, things like crypto and stuff. So you're most welcome to listen in. But I'm sure, Meghana, you would have answered that question also.
Yeah, so the way I've been looking at trends, especially among millennials, because we usually have a mix of students participating in the courses. Typically, how they think is they're usually attracted to a high return thing, attracted to something that's the in thing.
I can't blame them though.
Sorry?
Can't blame them.
Yeah, you can't blame them, especially in this world, So you see the markets going sideways or consolidating for 3 to 4 months, and then the whole focus shifts on something interesting. Cryptos, in our office itself, we are a stock training and coaching institute. We have all these youngsters working, more than half of them have crypto accounts. So you cannot stop them. The only thing that you can infuse is the way to think, as ma'am said, that you decide what's at risk. And I think your risk appetite changes with the age that you're in, your requirements. If you're starting a family, your risk appetite is different. You're well settled, established business or employee, your risk appetite is different. So I think any currency or anything that you're into, any asset allocation mode, it is no one bill fits everyone. You have to decide upon, it's a very individualistic approach, and hence the need for education. You get the right knowledge. What's my risk and what am I putting on the table? What is the kind of money that I need every month or every year for my health?
Actually, more than what money I have, what is more important when experimenting with peer-to-peer crypto and all, what is my ability to lose? That is more important. Can I lose? Means if I have X amount of money and if I lose entire X, will it impact my day-to-day living? Will it impact my children's education? If I am not having children, can I take my girlfriend to a 5-star? So all those things, you will have to see what is your ability to lose. Because if I lose all the money, what am I going to be without? I think that is what is more important.
Yeah. I'm sure uncle who was losing 3 crore every day still did not have that problem because
he had no problem.
Everybody was taken care of.
Yeah, obviously.
So cool. I hope you get to that point, and best of luck with your platform.
Thank you.
So ability to lose is what you have to determine when you experiment. What if money doesn't come at all? Can I live with it? It's okay. Then you go and do it.
Allocate small.
There are
Which you
people
can
who invest funds which they have kept aside for their children's education, for their children's
Which
marriage.
is,
Just by being caught up in this whole, circles that's happening outside, people flashing their returns and, the crypto bit options doesn't matter, but it's about, once you're enticed by this whole thing, then that's the problem.
Sure.
That way, any enticement is bad. Anything excesses are bad in life. You eat too much. Whatever you do, it's bad.
No, you're right. And
But with all this Insta, Facebook and YouTube, it's all about enticement.
Yes.
Whether it is for financial world or non-financial world, whether it's for our look or anything else, it's all about continuous enticement.
And it's a very interesting situation where on the one hand, we all seem committed to be building a world where things are more accessible. You're supposed to be more comfortable with who you are. but on the other hand, FOMO drives most of your actions.
Absolutely.
Actually, a
it's
couple
that-
of years ago, some 10-12 books came out with the same title called Enough.
Yeah.
Enough. So, and they have shown so many serials on TV where you buy the clothes and 30% you don't wear them at all. So these all excesses, be it food, be it clothes, be it gadgets, everything there are excesses. So
And-
same applies for investing also.
And because you have your coffee, I know that we have a little bit more time and you are not saying enough to us. So I will close, but I do want to the lady to ask.
So I just wanted to
Question.
ask you that the market is extremely volatile right now. So like ma'am said that, okay, you have these kitty party discussions, right? So when your friends meet, we all are discussing that should we wait for the corrections to get over? Is it a good time to invest? Should we withdraw? Some people are saying there could be a crash very soon, so let's withdraw immediately and close our accounts. So it's very, very confusing for us. What should we do right now? Should we invest? Should we trade? Should we stop? Should we continue? Should we wait? So I
Actually,
just
I'm
wanted to
thrilled
ask,
by
what
your
should we do?
question. I'm
Yeah.
thrilled because the conversation is not about hero, heroine, perfumes, bags, but it is about investment. So I'm
When we meet
thrilled.
at parties, these boys go
I'm
out to
thrilled.
smoke, and this is all that they talk about.
Yeah.
What are you
And you
investing in?
can
What are you
answer.
investing in?
So can I take that?
Yes,
Yeah.
please. I
No,
think
you're
all of
right.
us should respond.
And yes, markets have been lately very, very volatile. But at the same time, when the markets were at its peak, when Nifty was at its and marked its high at 18,600 in December 2021, I had a lot of investors who came back and said, "Oh, we missed the bus."
Right.
So, well, now with Nifty down more than 15%, the bus is there. I mean, you just need to start deploying your capital, but in a staggered manner. Don't just get into it because, yes, we don't know what's the bottom. We'll never be, no gurus will be able to tell you what the bottom is. But it's a good time to start in a staggered manner. If it's mutual funds, start through a systematic investment plan, a SIP mode, but start getting
So I'll
into
tell
it.
you, ma'am, what happens with mutual funds is because it's so slow, the growth, that like she said, the millennials, we sleep. We put the money and then we're like, okay, but it's not growing the way stocks.
But
Like short term is so quick, like your returns are so fast that you can actually not even go to work, then you just sit. Because you're like, I'm making money sitting at home. What's the point of like running behind meetings, running behind clients?
So
Just
that's
sit
again
every day.
two different things we're talking about. One, you're looking at making immediate profits through trading, and the other one is building an investment portfolio over a period of 3 to 5 years or more.
Right.
So depending on what approach you want to take and what is your objective, then the decisions and the approach will also change.
So when you lose money, will you work 16 hours?
24.
I think most precious commodity is time.
Yeah.
So are you going to just sit and feel happy your share went up, or are you going to work, get more money, and put more in shares and double your earnings?
So what I can make out from your question is not that it is your mutual fund investment portfolio which is corrected and you're worried or discussing and deciding next course of action. It is your selected stocks
Yes.
which
Yes.
is corrected, and you now want to decide whether I should buy the same stock more,
Yeah.
hold on, or cut my loss. So one thing which we always get distracted by in the markets, I feel, is because markets are liquid, transparent. So we see the price.
Right.
But what we are buying is business.
Right.
Okay, so once the way to review your portfolio, which will give you a little more easy sleep, is to review the business. This is the time when you are in panic that you'll put in more hours to know what have you actually bought, whom are you partner with.
Right.
Share is a sharing. Whom are you sharing with?
Right.
Is it a title, which is a jewelry business, which is into saris, which is also into eyewear? And is this business going to grow? Then take the pain of loss. I mean, mark to market.
Okay.
But are you in a business where you don't even know the promoter?
Huh.
You don't even know what the promoter will do, and still there is enough data to see in last 10 years when interest rates were going up. Could he hold his fort, or did he go into red?
Right.
So just go through the business that you're owning, which will give you insight and understanding. Should you stay put, or when should you average? You did one leg, which is acquainting yourself with the names and prices.
Right.
There are things like stockage, screener, where you can see what the businesses are doing. a little next layer will give you a very good understanding. And I always feel adversity is the time when you learn. You'll become a better investor, trader, whatever you call it. So please use.
She just gave you 8 hours of homework every day. So
At least one
I mean, see, if
I'm
you
sure
want,
you want to have more than 5-10 stocks in your portfolio.
Yeah.
Reading 10 stocks over 10 days, 20 days is not so impossible.
and stock market is like a marriage, You can't say, I don't want, to invest today. I'm going out, I'm coming in, exiting, all those things. You have to stay committed to the markets, be it up, be it down. You may lose money, you may gain money. But if you are engaged with the market for a reasonably long period of time, there is a guarantee you will make money. You cannot lose money.
And relying on market tips is not the right approach. I think research-based is more appropriate approach.
Yeah, and the wonderful thing is that there's a lot of knowledge that is available.
Access.
She
access.
mentioned screeners, so many screeners are available. You can screen the stock on whose P is high, whose this is high, that is. So many screeners will bring you down to just one share.
So there hasn't been a better time, I believe,
Yes,
for all of us
absolutely.
to level play. Especially, when I was doing my research, when you read about this old vintage traders and investors who have made it, look at, as she said, yes, exactly. My husband, he got started when he was 16 years. And I still have his charts where he was plotting open, high, low close and plotting them and then studying them. Now, at the click of a button, we have everything. So, I mean, we're more blessed than ever. We just have to use it to our advantage.
So true.
Exactly.
I think
So, yes. So, sorry. Now, suddenly, many questions.
I think last question.
Yeah, last questions.
Hi. Yeah. Hey, just from the back here. Hey, so thank you everyone for your time today. When you spoke about young millennial investors and how I think I related to that a lot when you said we have our eggs everywhere, which is mutual fund stocks, crypto, correctly said. So I think my question is 3 parts since I am a young millennial who is renting and investing. One would be how much do you guys think is a good ratio for rent versus salary? And the second would be by the time you're 30, how much do you think your portfolio should be? And I have been investing on platforms like Grow and DMAT is through Kotak. So I just want to understand your views on Grow as a platform to invest as well, because it's made it easier for me to know and understand the market since I come from a media background. So I have no finance, head at all. So that's made it a little easier for me. So yeah, I just wanted to understand these 3 things. Maybe it's a long one, but whatever you guys can answer at your own pace.
So, if I heard you correctly, you had 3 questions. Let me answer your last question first, which is any platform that works for you is good.
Exactly.
Just stay with it. Don't bother. And you can compare other platforms, see everything, but it really doesn't matter. As long as you are reviewing it daily, as long as you're doing something, you're good. Your second question was that you have a mishmash of what should be a portfolio that you should have by the time you are 30. And the answer is that nobody knows. You should reflect upon what is. So the way because we speak to a lot of women, what we have told them, what we like people to think about is, where do you see yourself as a happy person in an infinite amount of time? And ma'am
I would say that if you want how much money should you have at 30, then you should decide how much you are earning. Yes. And if you stop earning, will you continue to have that income from your portfolio? That is where you stop.
Yeah. So basically, the way to think about this is to think of near term. Will you need an emergency fund if you lose your job? But in the long term, what are you investing for? What are your goals? So think about that yourself. I think I didn't get your first question.
The rent versus salary ratio.
Rent versus salary ratio. Anybody has
Rent versus?
How much rent should you pay?
It depends on where you are staying.
Factors.
My son was staying in Vancouver, he was paying 10%. Now in Seattle, he is paying 25% of his salary. So it depends on where you are staying. If you want to stay...
The ideal ratio that will also help you save.
Ideal is if you get a free house in inheritance.
That's not happening.
But yeah, about 15, 20. But if you live in Mumbai, that's not practical. So There's really
No,
no
no, all
point.
other thing, there are so many components of your responsibilities.
Absolutely.
So if you're a student, you're paying fees, you're eating out, whatever you're doing. So all your things put together will determine how much you can spare for what. So I think it is a very individual question. There are no benchmarks really in this answering such
And at
things.
different stages in your life, you will be spending differently. That much I can tell you. When you have children, you will want a house that has access to facilities. When you're solo, you can even share a room with somebody in a exciting neighborhood. Otherwise, you'll move to Chembur and you'll say, I want to live in that space. So it's a very, again, personal question. But the important thing is that, because you're asking, the important thing in your question is that people should think about these things. They should consciously think about what's the share of my rent that's going, as an outflow, and therefore what am I left with to save and to invest. And on that very cheerful note, because I think all of us should be consciously
just
thinking
add
about money.
one
Yes,
thing?
please. Everybody, please give your closing remarks before we close.
Thank you.
Amisha will have a lot to edit, but yes.
Yeah, but just one last thing, because I can see the questions, and this is true millennial, new age audience. And I would like to say that the way in life, there are age-old principles that never change, that of trust, right? That is always having value. Similarly, in investments, there are age-old principles which will never change. You may not like to adopt, you may adopt, but what will work is that age-old principles. So while you all are doing this journey of investments, one principle which is most powerful in financial markets is that of compounding. Right? So what happens if you put, say, 1 crore at use? She said at 30, so till 60, 30 years, assuming it compounds at only 20%. Okay, you are looking at 20% return every 1 week while you trade. But over 1 year, if that 1 crore gives 20%, and that compounds for 30 years, can anybody take a guess what that amount would turn out to be? 30 years compounding at 20% of 1 crore. Have you ever done that maths? Any guesses? Quick guesses? It will be nothing less than 75 crores. So the kind of hassle that you are doing by doing that quick money, so keep some portion for that quick money, which is trading. Do invest. And while you take the decision to invest, let me reassure, India is the youngest nation in terms of demography. Every worker that comes out from the world, 33% plus is from India. So when the India economy is young, which means we are earning population. We are not like Western countries where everybody wants pension and they want to eat, but they're not working. So we're the best country. We have just opened up our economy. So we're the best placed, if at all, to harness growth which is lying ahead. And when that growth is underlying there, some of the businesses and good managements will really do well. So do target compounding. So investing. Where do you invest? Not in price. You invest in businesses. You partner businesses. So with this principle, when you start building your portfolio, I'm sure without much sleepless night, you will be such an happy and comfortable people as you grow. With your age, your wealth will grow.
Great summary.
Thank you.
Yes,
Great
last
summary.
year.
Last minute thought steps.
So as we, as if you take the sum of the entire discussion that we've had, it's always better to know what's happening in your portfolio rather than just outright delegate it to someone. I know wealth management is a great thing, but keeping yourself updated on what's happening in your portfolio, learning and educating seems to be a difficult route to take most of the time because it involves effort, time, money, a lot of things and discomfort most of all. But this is something that really pays rich dividends coming forward. And you are, we all are leaders in our own way. We have people looking at us, following us, our children, our family. So it really matters what route do you take. And the route of education, I believe, is always going to be the safest route when it comes to this.
So ladies, please lead in the journey of finance.
Yes.
Yeah, if I had to summarize again, my emphasis would again be on asset allocation because that's the tried and tested model. It never goes wrong. emphasis on diversification, quality, and start investing young. So, that's important because that is where the compounding effect comes into play. Do things in a staggered manner so you benefit out of the rupee cost averaging. So that's some of the few key things that you need to keep in mind when you're building your portfolio at this stage in life.
Super. Last word.
I'm a great fan of Amisha. I've seen her entire career throughout so many years. So I will echo what she says. And that is, one is what we say traditional thinking. See, Lakshmi and Saraswati are both women. So as women, we are genetically empowered to learn and to earn. So please imbibe those things. And second thing, what she says is compounding. SIP is the best way for compounding. So I think best way to invest is SIPs. These are my 2 thoughts.
Wonderful. That is so wonderful. And thank you to all of you again on behalf of Ladies Who Lead and my own personal behalf. It's been such a wonderful conversation. Thank you, sir.